This is the Commodity Show with Morgan Downey. I build Boxwood, hedge management software for companies with commodity price exposure, and I write the daily commodity news. Today, the man who wrote the book on why oil prices boom and bust. Rockefeller, Texas, OPEC. Someone was always managing the barrel. Today, nobody durably is, and my guess says we're in the foothills of the next oil boom. With Bob McNally of Rapidan Energy Group. Quick 2 minutes before we start, because today's conversation stands on 3 ideas: inelasticity, the swing producer, and spare capacity. Inelasticity first. This is why oil prices move so violently. If gasoline gets expensive, you still have to drive to work, and if it gets cheap, you don't celebrate by driving laps around a parking lot. Demand barely responds to price. Supply is the same. An oil field costs billions up front and almost nothing to run, so nobody shuts one down just because the price falls. When neither side gives, even a small imbalance between supply and demand has to be closed by a huge price move. That is the boom-bust engine, and it's been running since 1859. The only fix ever found is a swing producer, someone who deliberately holds production back and adjusts it, up in a shortage, down in a glut, like a central bank for oil. Rockefeller did it, Texas did it, through the Texas Railroad Commission, then OPEC. The barrels they hold offline, ready to open the taps, are called spare capacity. That's the market's shock absorber, and when it runs thin, there is nothing standing between you and a price spike. One more, the SPR, the Strategic Petroleum Reserve. That's the US government's emergency oil, stored in salt caverns along the Gulf Coast. It was released this year to cushion the loss of Hormuz, and it now sits at its lowest level since 1983. A buffer only works until it's drawn down. Okay, Bob McNally, founder and president of Rapidan Energy Group. Enjoy. This show is for educational and entertainment purposes only and is not investment, financial, or legal advice. Always do your own research.
Today I'm joined by Bob McNally, the man who wrote the book on why oil prices boom and bust. Bob is the founder and president of Rapidan Energy Group, the Washington-based energy advisory. Before that, he served in the White House as President George W. Bush's top international energy advisor on the National Security Council. So he's watched oil crises from inside the building that has to respond to them. And he's the author of Crude Volatility, the book that argues the calm stretches in oil's history were never natural. Every one of them existed because somebody was managing. Bob, welcome. Before we get into it, tell folks a bit about yourself, how you ended up in oil, and what you're working at Rapidan.
Morgan, it's great to be with you. Thank you for having me on, and it's an honor, and I mean it. There are few books that I esteem more highly, I can't think of any really, than your Oil 101. It's outstanding. I recommend it to everybody. I learned an enormous amount from it. I probably should be reading it as a refresher every once in a while. And really, I think we did a podcast together when Crude Volatility first came out, and I remember being over the moon because to even be on the podcast with you. So I want to say bravo, and I'm just honored to be with you on this, and I consider you a true genius and an educator on oil. So thank you for that. So, well, my voyage into energy was one more of drift than mastery. My passion was history, really, especially military history. After grad school, I served in the American Peace Corps, which is sort of a development program sponsored by the government. And I lived in a mud hut in Senegal, West Africa for 2 years. And it was a wonderful experience, but I didn't get rich. And so in grad school, I needed a job. And I was hired by an oil consulting firm called Energy Security Analysis. And they're still around. Sarah Emerson is a quite formidable oil analyst, energy analyst. And they were in DC. And so they hired me to be a gasoline analyst. And I accepted because I desperately needed money, not because I knew anything about gasoline or had any interest in energy. And then when I graduated, I looked at the pay scales of entry-level history teachers, oil analysts, my pregnant wife, and I decided to go into energy. But, that was during the first Gulf War, and I didn't take much urging because I came to realize how energy, especially oil, is so bound up with the subjects I have always enjoyed: politics, history, military, geopolitics, etc. And so whether it was oxygenated fuels and the program and getting ethanol and MTB into gasoline in the early 1990s and then the Gulf War, it just struck me, wow, oil is a commodity I think I could really learn to be fascinated with because it involves these other issues. And so it was. And so after cutting my teeth counting barrels at that firm, I joined a hedge fund that had an office in DC that tried to keep its traders from being surprised by anything officials did that affected broader financial and commodity markets. So I did energy, but also a fair amount of central bank watching and euro watching and stocks, bonds, currencies, commodities, and all policies that touch that. And then I got to know Larry Lindsey through Tudor, who was President George W. Bush's first economic advisor in the White House. So I went into the White House and served both in the National Economic Council and the National Security Council as the president's top energy advisor from 2001 to 2003, which was a pretty busy time. Enron to Iraq, I call it. Both domestic and international energy, California blackouts, 9/11. Enron was the largest bankruptcy in our country's history at the time, and so I had quite a full plate there, two plates, both national security and National Economic Council. Went back to join Tudor after 2.5 years in the White House and made partner, and got to about 17 years ago and looked around and sensed there might be new entrant opportunities in energy consulting, and that I was fortunate to have had a combination of both fundamental work as an analyst, but also deep immersion in policy and geopolitics. And so Tudor, the hedge fund I would work for, was a great supporter, and I spun out of there. They remain a client. Paul Tudor Jones, a great friend and supporter. So it was a very easy spin out, if you will. And that turned into Rapidan Energy Group. We're a 26-person energy consulting firm clustered in D.C. and Houston. We look at global oil fundamentals, global gas and LNG. We have an energy policy service, policies, regulations, clean energy, brown energy, you name it. We have a geopolitical risk service, which you can imagine is pretty busy these days. We have a power policy service to service the data center work, and a China advisory service as well. So we've got a good group, a merry band of experts and analysts and former CIA officers and everything. And all I can tell you is we have plenty of material to work with these days. We're pretty busy. And there's a lot going on at that confluence of what I call MPG, but not miles per gallon. It's markets, policy, and geopolitics.
That's a good acronym. And before we get on to the events of today, the Persian Gulf situation, just to set some broad strokes here, ignoring this year, your book's argument was that oil is inherently boom bust unless someone manages to swing. So with shale maturing, with spare capacity thinning, bring us into this year. What was the lead up into this year? Was OPEC Plus managing the oil industry until the beginning of 2006? So set the stage using the thesis of your book to get us to this year.
Sure. Yeah. So I think we need to step back, and if we look at oil prices, and we developed for the book, my research assistant, Fernando Ferreira, who now runs our geopolitical risk service, and I developed a monthly continuous crude oil price series going all the way back to the third quarter of 1859. And what that shows you is the oil price goes through eras or periods, many decades, of either wild oscillation, huge boom-bust price volatility, or relatively stable periods. Now, oil is intrinsically prone to wild price volatility because demand for oil products is extremely inelastic or insensitive to price, right? If we think about it's really transportation is the main use of oil, and it is a must-have commodity for which there are few scalable substitutes. I always tell folks, if you're hungry and chicken's expensive, you can buy beef or vegetables. But if gasoline's expensive and you have to get to work, you have no choice. Gasoline price goes up, you still have to buy it. Conversely, it's not like if the price of gasoline falls in half, we're all going to get in our car and just drive around, a parking lot somewhere for the sheer enjoyment of driving. So we don't really consume more when the price goes down, and we don't consume less when the price goes up. That's the insensitivity. And also on the supply side, as your book, Oil 101, made so clear, the energy industry is about huge upfront capital expenditures to find reserves, develop them, stabilize, transport them, export them, refine that oil into products, and then another round of transportation, storage, logistics, and sales. That huge industry, upstream, midstream, downstream, requires a massive upfront capital expenditures. Once you've sunk the capital, the operating costs are quite low, and you're going to run that system to the max because you want to recoup your investment and make that return for your investors. You're not going to shut down the whole oil system just because the price falls below a certain level or what have you. And so when you have a commodity like oil where demand and supply are very inelastic on the supply sides, any even small imbalance between supply and demand could be caused by a recession or strong economic growth, could be caused by a war that disrupts supply, or the startup of new production like shale that adds to new supply suddenly. Anything that tips supply and demand into imbalance can lead to huge price swings to enforce that iron law of economics. You can only consume what you produce, and they must balance. Now, inventories can and have smoothed that imbalance and that need for price volatility, but they don't eliminate it entirely because inventories, after all, are finite and costly. So that's what we learned from the very beginning. And there was a book in the 1930s with the title Quest for Stability that described really the history of the oil market back then, and I think it still applies. You can think about the history of the oil industry and energy policy in some ways as a quest for stability, a quest to tame that wild intrinsic oil price volatility, because after oil graduated from mainly an illumination fuel, right? In the late 1800s, what we were really after there was kerosene for lamp oil. It was not for transportation. In the early 1900s, we figured out electricity for illumination, and then we started to develop the internal combustion engine. We say, wait a minute, let's take this waste product, gasoline, which we used to throw away, and let's use it for gas and for transportation. And so since then, governments have really cared about price stability for oil. As we sit here today, the oil companies in the United States will soon be reporting their earnings, and there's going to be screams for windfall profits taxes and investigations of gouging. President Trump has already called for investigate. I mean, all that started happening 100 plus years ago when oil became extremely political. Okay. And the price became political. So what we've learned is, as you mentioned, and what the book discusses, is the only effective solution to tame this wild and unacceptable price volatility, because oil is, after all, the lifeblood of modern civilization, right? And central banks, military, airlines, huge industries, consumers, it affects everybody. And we simply can't accept prices that oscillate between peaks that cause or contribute to recessions and then troughs that force a shut-in of production and massive losses. And it's just, I like to say, you can't bake a cake on Space Mountain. You can't run a world on wild crude price volatility. Okay. So the question is, how do you tame it? And the only solution we found is to interject something that, again, doesn't naturally exist. Naturally, oil producers are producing all they can. Yes, they have to bring down their fields and equipment for repairs and maintenance, et cetera, but they are usually maximizing their investment in their equipment. But what supply managers have done throughout history is to say, wait a minute, we're going to have some regulation of supply in order to prevent the sort of supply-demand imbalances, and there we usually measure that by looking at inventories, that ignite this fearsome price volatility. And so Mr. Rockefeller, John Rockefeller, was the first great stabilizer in the oil market. He comes along a couple decades after the beginning of the oil market. He's a refiner, not a producer at first. And he realizes that these industries simply can't survive with these boom-bust price cycles. You didn't have much storage then. You had drillers literally pouring oil into streams that they couldn't sell or find storage for. So we had to bring order out of chaos. And he did by monopolizing refining and integrating with midstream. And he brought stability in the late 1800s and early 1900s. Even his detractors, Ida Tarbell, his nemesis, whose father was put out of business by Rockefeller and whose articles and books excoriated Rockefeller and Standard Oil and whipped up a lot of public sentiment against him. Even she said he did a good job at keeping oil prices stable. Okay. So we bust up Standard Oil. We didn't like the likes of Rockefeller and Standard Oil, big trusts. And so Teddy Roosevelt comes in and 1911, we bust up Standard Oil. And then what ensued was the last prolonged period of boom-bust oil prices. We learned back then that you don't have a swing producer, somebody stabilizing that production, that volatility returns. And again, now we're transitioning from illumination to transportation. So after World War I, you had price spikes, pent-up demand. You had crazy things happening. You had the U.S. Navy seizing fuel oil at dockyards in California at bayonet point. You had the Secretary of the Navy suggesting we nationalize the oil fields. You had the builders of buggies and carts who for 5,000 years had dominated personal transportation. They were running ads in the paper saying, we still have the horses and buggies. We can still go back to that. When people were just freaking out about these gasoline price increases. But, we found that when oil prices go up, and they went up high in the early 20s, the industry finds a lot more oil. So that the boom of the early 20s turned into a bust by the late 20s and early 30s. And by that time, Texas had become the lead producer. And I love this. Morgan, I don't know about you in your journey in energy. One thing I enjoy about it are the ironies and the little tensions and uncomfortable moments that it teases out. And what I really enjoyed researching about was how, Texas. I joke, I'm from Connecticut, but Texans, I work for a Texan president. I think Texans are sort of put on earth by God to produce oil and to limit the role of government in business there. Okay. And I admire them for that. However, in response to the price busts after the enormous big fields, Black Giant and others were discovered in Texas in the early 1930s, Texas, of all places, first of all sent armed troops into the fields to prod drillers away from their private property at bayonet point, and then instituted through you mentioned the TRC, the Texas Railroad Commission, some of the most heavy-handed government intervention, and forget about energy, economic activity I'm aware of. That Texas Railroad Commission met every month in Austin, Texas, and they imposed quotas on drillers well by well, field by field for 40 years. In the 1950s, we had 1/3 of global oil production capacity held offline in spare capacity. 20% was in the United States, about 13% outside. The Seven Sisters cooperated with the Texas Railroad Commission. Anyway, what a great example of how, again, some of the most oil-producing, government-limiting people resorted to what might be called communism to banish for one reason and one reason only, because they couldn't accept the price volatility. The founders of OPEC learned from the Texas Railroad Commission. The founder, Juan Perez Alfonso, a Venezuelan, was in exile in the 1950s and went down to Texas and learned and said, this is amazing. And there's a revolution. And then he's the energy minister of Venezuela. And he's like, this is awesome. He goes to Saudi Arabia, gets his counterpart and says, you got to come with me and see what these Texans are doing. They go to Texas. They hired a guy from the TRC. Say, show us this stuff, this quota stuff. Anyway, Texas takes over from OPEC, rather I should say OPEC takes over from Texas and manages the market until about 2008. In my view, if you just look at a price of oil, and perhaps we'll show that, but if you look at a price of oil and you look at the last 25 years and you compare that with the previous 90 years, you will notice that the amplitude of the range around which oil prices oscillate over the last 25 years is much wider on a real or nominal basis, whatever you want, than the previous 90 years. And not only that, the causes of the booms and the busts, or the rises and the drops of oil prices, are very different in the last 25 years than they were before then. Before then, the only reason we would really have an oil price spike tended to be because of a war in the Persian Gulf that disrupted supply. And the only reason we would have a drop in oil prices was either a recession, the most often, a recession, demand would suddenly fall, or in one case, 1986, Saudi Arabia flooded the market. They did, to punish the other cheaters in OPEC. But that was the exception to the rule that oil prices tend to be stable unless there was a war or a recession. Yet in the last 25 years, we've seen oil prices quintuple from $30 to almost $150 a barrel without a war. In 2014, after 3 years at $100 a barrel, without anything happening in the economy or the fundamentals, price structure collapsed from $100 a barrel to $26 a barrel in about a year. Nothing changed on supply. Nothing changed on demand. Nothing changed in the economy. A tumbleweed didn't blow down the dusty street, and oil prices collapsed suddenly by 75%. Why? Well, one, if you will, load-bearing assumption, one key foundational idea that sort of stabilized market thinking about prices collapsed, and that was that Saudi Arabia, this lead swing producer, which sort of took over for Texas, that it would be willing to surrender its market share to the growing U.S. production, not just growing back then. When the U.S. shale oil production after start up to 2010, you had Brazil, Russia also coming on very strong. And, somebody had to cut. But for 90 years, we had known that there was a Texas Railroad Commissioner and OPEC whose job it was to, if necessary, cut production to stabilize prices. And Saudi Arabia said, we're not going to do that. We refuse without Russia. Russia said no. So all we did is remove the long-held and valid, until then, assumption that there would be a price stabilizer, which you had had since the early 1930s. And suddenly you didn't. And you knew if there was no one who was going to cut under shale, the price of oil was going to collapse, and it did. And the only reason it stopped falling in early 2026 at $26 a barrel was because Russia agreed to join OPEC plus. So anyway, so I think if you look back over the last 25 years, I assert we are in history's third era, sort of multi-decade era of boom-bust oil prices, where we have swings between, we went up to $143 a barrel, we went down to negative 37 during COVID. And volatility, chronic volatility has returned. And the main reason is the absence of a durable, and I want to stress the word durable swing producer. That like a central bank there every single day, every single week, every single year, year after year, willing and able to adjust wellhead supply, if you will, introduce supply elasticity that normally doesn't exist in economic terms. And we haven't had that. Sometimes OPEC Plus, which is a group that is attempting to replace OPEC, sometimes they succeed and sometimes they don't. But we need that durability to, I think, anchor market expectations, because it's very difficult for producers to decide whether they can drill, or airlines to know what kind of planes they should buy, or car makers what kind of cars will be in demand when you have oil prices gyrating so wildly.
Since 2012 onwards, U.S. shale has been the swing producer. Price up, rigs up, barrels in 6 months. Is it going to require U.S. growth plateauing, and then we test Saudi's willingness to revert to its traditional role as a price stabilizer? Or do you think Saudi Arabia has given up on that role? Because like all Middle Eastern countries, there's this push away from the oil market. UAE is famously done it with Dubai and tourism. So they're still producing a lot of oil and will continue to, but they don't necessarily really seem to care about being the swing producer. I mean, I guess you say they should, but do they?
Yeah. So great questions. So first of all, when shale oil first appeared, it became fashionable to say that it would be the new swing producer, because as you noted, you can get to shale production a lot faster. The hydraulic fracturing process results in quicker production and much higher initial production rates than conventional oil. So instead of years to find and develop oil, like you say, it can be months. We know where the resources are. It's just getting the hydraulic fracturing set up and drilling. But we also know that the initial production rates are very high, and then shale drops off fast, as you know. So to maintain high production, you need to be constantly fracking, and fracking is a high cost activity compared to conventional drilling. So in a way, it gets to a higher, if you will, it's almost like in a way like an OPEX than conventional. But I strongly believe in shale oil is in no way, shape, or form swing production. So I think we have to define, what do we mean by swing or supply management? Typically, we mean that's production that can be adjusted in weeks, not even months. It's production that can cycle up or down by many millions of barrels a day within weeks. It's production that can be cycled up in weeks by many million barrels a day if necessary, with the agreement of the authorities. So no antitrust concerns. So governments have to be sanctioning it. And all that activity has to happen for the purpose of stabilizing prices, even if that means the country who is doing the swing production is losing market share. All of those things are the complete opposite of shale production. They don't swing fast enough, even though it's much more flexible. It's not quick enough to be swing production. Even if it was, the shale producers are not allowed to collaborate and coordinate on production decisions. They'd all go right to jail under the Sherman Antitrust Act. And I don't see the government really coming in and restoring it. Remember, back in the day of the Texas Railroad Commission, those U.S. wells were very low-cost primary drive wells. So they were just, poke a hole and natural pressure, and then maybe there was secondary recovery, but it was low cost. They were low cost wells. The Saudi wells are lower cost wells. Shale oil is high cost, and you're just not going to shut up. It's like opening and closing a factory. You're just not going to do that in the same way you would go to a Christmas tree on a primary drive well and turn it up and down. And so shale is certainly more flexible than conventional oil, certainly more responsive to prices both ways. When the price goes down and hydraulic fracturing or completion stop, production tails off pretty fast. We saw that in 2020 during COVID, when we lost about 2.5 million barrels a day in a few months. So yes, it's flexible, but that didn't prevent oil prices to go back then in COVID to negative 37. The oil market is bigger and faster moving than even the shale sector. And I don't think shale can play that role. And I think that's been demonstrated. So then comes the question, you ask a very good question. Well, does anyone have any interest in doing it? Will Saudi Arabia continue? My answer is yes, because they have no choice. No one does swing production because they enjoy it. Nobody ever enjoys having to choke back on their production that they invested in, much less to see a competitor gain market share, especially one that's not participating in that restraint. No one likes doing that. They only do it for one reason. The alternative is worse, meaning you get those price drops. And it's the experience of price collapses. It's the experience of the absence of swing production that creates the will for swing producers to act. Now, what my book is about, it's human nature, right? We, We hate doing swing production, and if you have moved several years beyond, let's say, the last price bust, you may have forgotten you're enjoying higher oil prices, and let's say a surplus comes along and now the group has to cut again, and maybe you don't want to cut. Maybe you don't remember the last bust. And if you refuse to cut, well, then nobody cuts. And then before you know it, the price has to collapse again to teach everybody. It was the price collapse from $100 to $26 a barrel, as I mentioned in 2015, that convinced Russia to join OPEC Plus and begin accepting quotas. And then 5 years later, we had COVID. And of course, that was a massive sudden demand shock. But in that meeting in March of 2020, they were dealing with COVID, and the group said, well, we're all going to have to cut. And by this time, Russia had said, no, let's have the Americans cut. We don't want to cut anymore. And they didn't cut, and they instead they all ramped up production, and we saw what happened. Prices collapsed. So, I think Saudi Arabia will refuse to do all of the cutting, all of the restraint going forward. If there's an enormous amount of restraint that is required, I don't think Saudi Arabia would do all of it. It would rather see the price collapse, knowing that the price collapse will instill a will among other recalcitrant producers to join them. Right? Sometimes you need to crack the whip. Like 1986, they flooded the market. Sometimes they need to teach a lesson to cheaters, if you will, that if you cheat, we all lose. No one wins by cheating. So I don't know. I'll tell you this, though, finally, if you look at what causes swing producer groups to fail, it's not so much that they don't agree to restrain supply when there's a surplus, so they keep a floor under prices. Because if you think about it, when there's too much oil, there's a surplus, and the question becomes, will we agree to cut production? At least you have the choice to do that, right? But where swing producers, the Texas Railroad Commission and OPEC, tend to lose control is not in a surplus, but in a deficit. When the market's really tight, when demand is outstripping supply, when the swing producers have not invested enough in wellhead production capacity to both meet the demand for their crude and keep that spare capacity buffer that they need to contain prices, because they don't want to see price spikes, because price spikes just lead to price busts. So if you think about the Texas Railroad Commission lost control of the market in early 1972. Its 4 decades of managing the market by holding back production ended. It went to full production, 100% production for the first time. Demand was really strong in the 60s, early 70s, and they hadn't been investing enough in supply. Saudi Arabia ran out of spare capacity similarly in 2008. And so I'm concerned as we look forward that we're going to see strong demand. I don't believe in this peak demand narrative. I think that's starting to crumble anyway. I don't think we've invested enough in oil to meet demand in a world where it grows after 2030. And I think this war in Hormuz may cause damage to supply and infrastructure. So I see us going into a boom cycle, and there's every risk, I think, that OPEC Plus, if it may struggle to meet demand for oil and contain prices. So that's kind of the thing to watch, I think, is the big question right now is OPEC Plus, this group that formed when Russia agreed to join OPEC and brought in some other countries. Will this group turn out to be the 4th successful, durable swing producer or not? I think the jury is still out, but the challenge will come when the market gets really tight. There will be some concern in a surplus. UAE, which is a very key member of OPEC and OPEC Plus, has decided to leave, so that's a challenge. But at the end of the day, these producers know the history and they know the economics, and they either, to use an expression we use here, they either hang together or they hang separately, if you will, in terms of having an oil price collapse.
Interesting. And we're talking about the supply side price management of the oil industry. What do you think about the recent development of China as a nation managing as a swing demander? They've actually cut imports by quite a substantial amount, almost like a Saudi Arabia style, but on the demand side. That's kind of strategic balance here on the high price side. What were your thoughts there on that's a new thing? I mean, that's never really been. It's been building for years, but here we are.
You're right. Yeah, you're right, Morgan. The big surprise was how quickly and substantially China dropped its runs and its imports of crude oil from 12 million barrels a day suddenly down to 6, 7. Amazing. China's supply response, its abrupt collapse in imports, no question has helped buffer the oil market during the loss of Hormuz so far. Although I think that's ending. I think China is beginning to start to resume imports, not fully, but partially. But I don't think that's a durable way to live. I don't think China is going to be a swing buyer in the coming years and decades. And again, for the oil industry, as your book pointed out, given the scale and the lifespan of the investments that the industry has to make, they have to be reasonably sure of making a return over decades, not just year to year. And China flexing its imports was marvelous to see, really. But in no way, shape, or form does that mean China is going to be the regulator of price, in the coming decades and so forth. I just don't think it can afford to do that as a regular sort of activity.
So you've sat inside the building in Washington where decisions are made about energy, and you've been involved in those discussions. What does Washington actually think about oil prices? I mean, there's a political aspect, of course. No one wants high gasoline prices. No one wants to kind of be associated with encouraging oil production, or at least some administrations in the past have not wanted to have that association. But are there kind of certain trigger levels? Is it the classic $4 per gallon national average? Are those kind of trigger points or set points key for Washington? Or do people kind of exaggerate how much emphasis Washington puts on oil? Is it that integral to every decision that's made in Washington?
Washington is in one of two modes, if you will, when it comes to oil prices, gasoline prices. Either Washington is oblivious. They don't care. They don't really pay attention. I mean, most Americans know what the price of gasoline is just because you see it every day, but it's not an issue. And the other mode is absolute panic because it's an issue. And the difference between complacency and ignorance, who cares, and sheer terror, and I need to know what the price is doing every single day, is whether the price is high enough, let's say, to cause trouble. Now, you raised a good point. $4 gasoline used to be really high, but the consumer's gotten used to that. We saw $4 gasoline in 2011, 12, 13, 14. We've seen it now twice this year. I think the consumer has gotten, acclimated to it. It's probably now, we saw a record high price of $5 gasoline in 2022, but that was very temporary. I think what really matters, and I think it matters for President Trump, is the price of gasoline high enough or getting high enough that it starts to destabilize the bond or equity markets? Because that's when real problems start, and Washington gets very worried, right? And as we sit here today on July 23rd, I think bond yields are starting to rise. It's clear on the recent rise in oil prices. So far, equity markets have shrugged it off. But when you have oil prices spiking to levels that start to spill over into equities and bonds, then it becomes a 5-alarm fire for the White House, whoever the president is, and so forth. So I think that's really it. I think the consumer has gotten used to $4 gasoline. It's not going to provoke outrage per se, but boy, when the equities start falling and interest rate starts rising because oil is soaring, then I think that's when it becomes a real concern. They don't have really good tools.
In 2008, the rally to 150 was the precursor to the financial crisis, the rally to crude oil to $150. Yeah. But you mentioned so there's two tools. There's the SPR and there's sanctions. There are two of the tools. And both have been used this year. We've had SPR releases in the US and globally, and we've had sanctions relief for Russia. What do you think of those two kind of uses of those two policy tools, the SPR and sanctions this year?
Yeah. Yep. So the more important one was the SPR by far. So the SPR, in a way, Washington has corrected an error that it had been committing for about 10 years. So once the shale revolution happened and we became a net exporter, many people in Washington thought on both sides of the aisle, Democrats and Republicans, that we don't need such a heavy strategic petroleum reserve anymore, such a big strategic petroleum reserve anymore. Thinking that, the only thing that matters is our physical import dependence, and we don't have to worry about that. And so we sold it down. Congress just whittled away at the strategic reserve just to raise money for non-energy purposes. And then President Biden, of course, drew down heavily, about over 180 million barrels during the Russian invasion of Ukraine, even though it did not result in a major disruption in supply. But I think we've learned a lesson. I think, now we're at the lowest level since 1983. People are debating where the bottom is. And I think hopefully Washington has learned a lesson that it was folly to sell down the strategic reserves. The release this year with the other IEA countries, 400 million barrels, no question has helped buy time anyway and cushion the loss of Hormuz. So I suspect that going forward, there'll be more interest in refill. With regard to sanctions, I think it was pretty minor. That was really about India, which was the main buyer of Russian crude after the Russian invasion of Ukraine, and Russia lost many of its export customers. And the U.S. urged India to do so. And so I think the sanctions relief were on the margin intended to help make sure India could buy that crude. Part of it was to make sure the crude would find a home. Part of it was to help India, which was, of course, what is it, only 3 or 4 sailing days away from Hormuz, and perhaps the first major economy to really be slammed by the loss of Hormuz, that and the LPG it consumes. I mean, it literally cooks dinner on Persian Gulf LPG. And so I think that was as much to help India as it was to suppress prices. But the SPR was much more important. In Washington now, the big debate is, well, it's not so much of a debate openly yet, is will the administration impose export restrictions? Because our crude and product exports are also helping offset the loss of Hormuz. And we're at record levels on both. We have been it recently. And, there are some folks who think that we shouldn't be giving away our oil, and that it would be a good idea to restrict our exports, to bottle the oil up here and reduce prices. That's the theory anyway. So far, the president has ruled that out. The vice president, secretary of energy, others have said absolutely not. And I hope they stick to that. But that is a concern, a worry. I know in 2022, the Biden administration seriously considered export restrictions. And there will be people arguing for it if oil prices continue rising here later this summer and into the fall. So that'll be the big policy. One thing I learned, Morgan, working in the White House, is the secret to good energy policy is stopping bad energy policy. And a lot of the work is stopping bad ideas, not just coming up with good ones. So, and export restrictions is one of them.
Very true. And you could also tell that to the EU as well. I'll be diplomatic. I'll call it unusual energy policies in Europe over the last 10, 15 years.
Right.
So, and if you're right about volatility coming back into the market, and we've seen it here. We've seen the initial rally up to 150, back down to 70. Now we're back up to close to 100 again. If you're right about volatility is going to return more so than it has historically, how does that play out over the next 1 to 3 years? I mean, do you think you're going to see volatility on the upside and the downside? Because, as you mentioned, the oil industry gets booms, but they're unfortunately followed by busts.
Right. Yes. So what we should expect, barring black swan events like COVID and Hormuz wars and things, I would think that oil prices will oscillate over a 3 to 5 to maybe 7-year period between booms that cause or contribute to economic slowdowns, if not recessions, that then trigger busts that threaten or cause involuntary shut-ins of production, right? That's the way the oil market works without an effective durable swing producer. The price enforces the iron law of economics that supply and demand must balance. And because, as we talked about that inelasticity, while demand for oil, for fuel, is very inelastic to price, it's very elastic or sensitive to GDP growth. So when you slow the economy, you abruptly slow oil demand. And that's what then causes the price of oil to collapse, $143 to about $30 a barrel in 6 months. So I think, over the next 1 to 3 years, so much depends on how this war ends and whether there will be critical infrastructure damage. It's just not about Hormuz and restoring the flows of merchant vessel transits, but it's really also about, when Iraq shuts down a Rumelia, can it come back quickly and produce fully? We don't know. We're doing new things here. Will there be damage to infrastructure? If so, how much and how long will it take to repair? So many questions, but I think we are in the foothills of the next boom cycle for oil prices. The Hormuz war, if anything, may have accelerated the beginning of that boom cycle. Before the Hormuz war, I had been thinking we wouldn't really tighten up until the end of the decade, but that could happen sooner now. And again, I think we just haven't been spending enough on investing in finding new fields to offset declines and meet demand growth in the coming years. If I could, before we got into this war, first with Venezuela, which is very short, but then now Iran, I think the big theme in oil markets was the crumbling of this peak demand narrative. For the previous 5 or 6 years, the market had been dominated by a consensus view propagated by the International Energy Agency in its forecasts that oil and gas demand globally were about to peak in 2030 or so, and then either plateau or collapse due to climate policies. And folks believed that, and they invested accordingly, meaning they didn't invest. is one more reason why oil companies just returned cash to shareholders or built up cash reserves. They didn't drill, they didn't invest because the whole world was telling them that oil and gas demand were about to go the way of horses and buggies 120 years ago. And so we are, in my view, we are underinvested in the medium term, even before we talk about the potential loss of supply from the Middle East. And we have some catching up to do there. But again, that wasn't a problem. I think that wasn't going to really hit until about 2030. But we'll see if this Hormuz crisis doesn't accelerate that. And then the question will be, can OPEC Plus, Saudi Arabia with its spare capacity, can it contain the upward prices and avoid a ruinous spike? Because if we have a ruinous spike, what it does, and we've seen in history, is oil price spikes tend to detonate fragilities elsewhere in the economy or financial system. So the 1990-91 was a brief price spike, but that helped detonate the savings and loan crisis and so forth. And in the 1970s and 80s, similar. Banking system problems, 2008, you mentioned, Lehman Brothers. I mean, it's not oil alone, but oil price spikes can then destabilize other or exacerbate other weaknesses and fragilities that then cascade into a broader downturn. That's unfortunately what happens. It is an effective, if brutal, way to balance the market.
Good stuff. So thank you very much, Bob. This has been great, very insightful. And where should people follow your work?
Yeah, we have a website, www.rapidanenergy.com. We have a Twitter, X feed. I'm on. Many of my colleagues are on individually. Rapidan has an X feed and a LinkedIn page. And welcome folks to follow us and keep in touch. We're pretty much a behind the paywall organization. We're a consulting firm, so we do some things public facing, but a lot of it is for our clients, financial, physical, governments, all who care about looking around corners when it comes to that intersection of markets, policy, and geopolitics. But Morgan, thank you very much for having me on. Again, it's a great honor, and I should be the one the next time should be interviewing you, because again, you're a towering expert, and your book, again, Oil 101, is just unsurpassed in terms of its coverage explanation of just how the oil business works from discovery right through to end use. It's just fantastic.
Thank you very much, Bob. And of course, you've got your book, Crude Volatility. I'll put a link in the show notes to this episode. And it's been a pleasure, and I hope to speak to you very soon.
Thank you.
That's it for this one. Thanks again to Bob McNally. His book, Crude Volatility, is linked in the show notes below. You can follow Bob and the Rapidan team at rapidanenergy.com and on X and LinkedIn. If you got something out of this, follow the show wherever you listen. You can find my daily commodity news and more at boxwoodapp.com. I'm Morgan Downey. Talk to you next time.